Viewers, welcome back. So you said comprehensive financial planning. Okay, so when it comes and your expertise in financial planning. So when you say the comprehensive financial planning, what exactly you define the comprehensive financial planning?
What to me a comprehensive financial plan is a financial plan that gets very important results achieved in an effective manner in all the areas of financial planning. So that would be the obvious one that most people think of as investments, but some others include estate planning, insurance needs if applicable, cash flow management, debt reduction, and the whole plan. And a good plan will, if you do it right, you'll be able to have a base plan, and then you'll be able to, don't really love this term, but manipulate it. So say, well, what if I was to retire a year later? What if I was to live 5 years longer? What if we downsize the house? What if we don't downsize the house? So by looking at all the options, you can look at what makes sense. Now, one of the things that our company talks about is plan, unplan. And no year is more appropriate to talk about that than the year after 2020 and 2021 because of COVID. Like we all had a plan for 2020, whether it was a personal plan or some sort of financial plan, but that all changed. The reality is, well, there won't be a COVID every year, but there will be something. It might be something that happens with people in your family. It might be something that happens to the stock market. It might be what they call COVID, which is an exogenous or kind of outside event that happens that affects everyone.
I'm paying taxes each year.
Yeah. The income tax rate, perfect example. There's things that change all the time. So you do have to change it and adapt. But the important thing is to have a framework, a base. That's what I think is important. So the financial plan should change that. And if you think of what your goals were 5 years ago, think of what they are today. Has anything changed?
Well, it changed over the time, of course, right? So we will discuss about RRSP. And my question to Tyler, what is the purpose of RRSP?
Very good question, because so many people hear about RSPs, but they're not quite sure, should they contribute, should they not contribute. The RSP itself is not an investment, it's just a designation on investment. So you choose the investment, then you decide whether to register or not in an RSP. An RSP could be a GIC, a bank account, a stock, a mutual fund, or a segregated fund. The main purpose that you would do one is to reduce your income tax. That's the immediate benefit. Often people do it to save for the retirement, and some people do it, it's usually not the primary reason, but you can use use an RSP as a first-time home buyer in some cases if you qualify for the program.
Okay, so first-time home buyer, we'll talk about that, but let's talk RRSP, Registered Retirement Savings Plan.
Yes.
So what is the purpose of that? It is the savings, or is anything else there that's more important?
Well, let me give you an example. So say for someone like yourself, say you're years from retirement, and right now you're in a various tax bracket. Now, if you're making $40,000 a year, your marginal tax rate would be 20%, meaning if you made $1 more, it's taxed at 20%. If you were making $240,000 a year, you would be taxed at 53.53%, the highest rate in Canada. So if you, for example, were in just for simplicity, let's say you're at 50% bracket, you put in $10,000, you would get back $5,000 in taxes. If you were in a bit of a lower income and you only, still fairly high, 20% tax bracket, you put in $10,000, you get back $2,000. So the idea being, someone like yourself, you're working, you're making a high income, you get that tax break. And then later in life, when you take that money out, if you take it out in a year, say you're retired, you're not making that much money, you might be able to take it out at a lower rate. The other thing it does is it funds your retirement, because all those years that you have the money in RSP, they are tax deferred growth. So you don't actually pay any tax till you take it out.
So that means that what you are contributing in RRSP, that you are getting a tax bracket for it.
Yeah, you're getting a tax break for the contribution.
Yeah.
And what should be said right now is, if you contribute and want to deduct the RSPs for a certain year, is you can deduct it for the year you make the contribution. You can also do it for the next 60 days. So for example, if you're in the position between January 1st and usually March 1st, and leap year is February 29th, if you put a contribution in say 2021 in those 60 days, you can use it to reduce your taxes for the 2020 tax year.
So here is a very interesting question. Okay, the RSP when February comes, okay, government, banks, everyone start promoting it is a time to contribute in RSP. Is that seasonal? That February month is the month for RSP contribution, or it is actually year round?
Well, the reality is to get the best return on your RSP, it's generally best to invest as early as possible. So for example, if it's 2021 and going back to the beginning of the year, it's say you on January 2nd knew how much you could put in for the 2021 year, you could get a head start on all the other people in the bank's advertisements by putting money into your 2021 RSP. However, a lot of people in a lot of areas, one being investments, they procrastinate. So they haven't done it in January of 2020 for the 2020 tax year. So all of a sudden it's February 2021 and oh my goodness, like if I don't get this in.
Well, so it is basically, so if I understand, it's for those procrastinating to go at the last moment, and all those banks and the companies, they're picking them, and the government as well. This is the time to contribute. The month of February and some part of the March is the time to contribute in RSP, but it is year round, so you can contribute at any time that you want to.
Yes, you can
right?
do every time.
Yeah.
And when you said part of March, it's the first 60 days of the year, so only March 1st. So some people every year tend to think in mid-March, oh, I can still do my RSP for the year before. No, you can still do an RSP, but that counts
for the next month. Next year, sorry, yes. For the next year. Okay, all right. Now, RSP contribution. Now, what is the limit on our RSP contribution?
Well, basically the formula, it's 18% of the prior year's earned income less your pension adjustment plus any unused contribution that you have from years past. So to give you an example, let's say...
Can you give me an example of numbers?
Yeah, sure.
Like let's say someone has an income of 70,000.
Yeah, well let me do an easier one.
Okay, easier, give you numbers with easy numbers. Yeah.
We'll do 100,000.
Yeah, 100, oh, okay, yeah, that's easy numbers to pick. Okay, yeah,
18% of that is 18,000, so you'd have 18,000. So if you had never had RSP limit before, see, and that would be based on your 2019 income. So the 2019 gives you room for 2020, which you can contribute in 2020 or the first 2 months of 2021. So this is the first time you've heard that. You're probably a bit confused. But the one thing you can always count on is when you do your income tax return and the government gives you your notice of assessment form, or you can call the government to get this info too, you ask, what is my RSP contribution limit for this year? And they'll tell you, or this piece of paper, it'll tell you. So
the RSP, this notice of assessment, actually, there's a one sector that is actually defined that what is the contribution limit that you didn't use or you can use in the future.
Yeah, there's a couple of things. There is the total contribution room. So it does that calculation I just did. So in the example I gave, say you had the 18,000 that you could do from that year, plus you had 120,000. Say it's a 60-year-old person that for years they're nowhere close to their limit. So it'd say 120,000 plus 18,000, your new limit, it's 138,000. The one thing sometimes people don't do is sometimes at the bottom, if it applies, it'll say you may have contributed but unused deduction rooms, meaning you put the money in, but for whatever reason, whether you forgot or it ended up you didn't make that much money that year and it didn't make sense, you didn't deduct it for your RSP. Well, just you have to make a note. And I do recommend people do use a tax preparer, although I know some people like to do it themselves and there's a lot of programs, but for the RSP, that's an example. And so you can do the calculation, but you don't
18%. 18% of your of your gross income.
18% of your gross income, yes.
18% of your gross income, and you can add up the previous year if you didn't use that for the contribution.
Yes, and the key is you said the word you can do it, but it's easier to let the system do it for you because they'll do it for you.
Okay.
So you don't have to. Of course, if you think
All
CRA
right.
has made a mistake, you can.
Okay. So if I contribute more than what I supposed to contribute or put in RSP, what is going to happen? Let's say that I supposed to contribute from last year or last 5 years, I didn't contribute. Okay, I have income, and the government calculated that what was the RSP contribution limit that I have from those years. Now this year I decide to contribute, and I had a quite bit money in my hand, and I want to take the advantage of the tax deferral program and want to contribute in RSP. So that total amount, that how would that be calculated though? If I put more money than what I am designed to put, or defined to put.
In short, you don't want to do that. And I'll explain the penalties. So first of all, the limit, you can go up to $2,000 over the limit without a penalty. If you go more than that, there's a penalty. 1% of the excess is subject to penalty tax. Now, to take that out, well, I'll just, because it can be a longer conversation, I'll just say you want to talk to either CRA or a tax professional, because there's actually a couple forms. There's a 3012 form and a T1OVP 76.
Well, all those technical things and stuff that you want to go, but it's better to go with a tax professional and get the advice from there, I guess, right?
Yes. Bottom line is, just if you can, don't contribute, over contribute. And if you do, get it worked out, because it's not as simple as you just withdrawing the money the way you would normally withdraw.
Okay. So RSP contribution and RSP deduction are the same or two different things?
Well, actually, that kind of applies a little bit to what we were talking about in some of the past points, which is the contribution is how much you can put in. Now, normally when people contribute, they deduct it that year. However, you don't actually have to. You could deduct it for a future year. An example might be if it's early in 2021 and you decide that you want to put money into RSPs because you know you've got a good, nice salary this year, but then for whatever reason you get laid off, have enough of your job, you end up not making much money this year, and you say, well, I'd love to have that RSP deduction, but this year I didn't make enough money for it to be worth it. You can actually use it for a future year. And as I was saying before, as long as you're within your limits, that's okay. You just don't deduct it that year. And for some people, I've noticed some people in the first 2 months of a year, they'll put money in for that last minute thing we were talking about. They realize, you know what, some of that money might be better to go to next year, so they can deduct a part of it, and you just carry the other part forward to a year that you can deduct.
We will take a short commercial break.